Now, let me welcome our speaker, fellow TXCPA Fort Worth member, Tram Lee. Tram is a duly licensed CPA and attorney. She works with clients on a variety of state and local tax issues and assists businesses in responding to notices issued by taxing jurisdictions. She has represented taxpayers before the IRS, the U.S. Tax Court, and assisted clients with complex tax issues. She has also taught state and local taxation over at UTA. So we have a lot of UTA graduates in the chapter, of course. So that said, let's let Tram, our kind of resident state and local tax expert, take it away.
All right, so our agenda today, this is the sales tax update. We're going to cover economic nexus, marketplace facilitator laws. We'll also dive into some income and sales tax automation and some other related considerations. The focus of kind of our presentation today will, really be generally multi-state, but I do have quite a few slides that touch upon, how, these new sales tax developments applies in Texas. So economic nexus is our first area here we'll cover. And so the slide here just covers a little bit about the history of state taxes. I think it's always good to understand kind of where the tax comes from and how it all began. And sales taxes, been around for about 100 years. And, truly when it was, was born right around the Great Depression, it was really focused on, taxing goods and manufacturing and items that, the way people were consuming items back then, right? Where you bought, the goods or the items at your local store. And it was a pretty, the way the system was, I guess, developed and the way, the states imposed the tax was based on, how we did business back in the 1930s. So, this idea of imposing tax truly, has its basis in the Constitution on, what states can do, how they impose it, and on what, right? So I guess with sales tax, it's truly one of those things where it's uniformly applied, like everybody pays the same rate. So truly it's a regressive tax, meaning those with making higher income pay the same amount as those who don't make as much, obviously. So that's a little bit of the history on sales tax. Okay, and so truly this section here covers nexus. And as I said earlier, there's this constitutional concept called nexus that pretty much exists so that states don't overstep their boundaries. So they don't impose tax that, either harm or, unduly burden interstate commerce. So that's why, this concept of nexus even exists, why we talk about it, why it's so important. And, pretty much, whether or not a state has, the power to impose sales tax on a business, require them to collect and remit the tax to state, there are definitely limitations. And this limitation historically has been referred to as physical presence. And, there was a case back in 1992 that the Supreme Court ruled that, hey, you have to have physical presence in a state in order to be required to start collecting and remitting tax to the jurisdiction. And, this decision was, decided back when, before internet really existed. It did exist, but not really. So there were a lot of things, right, that through the years, there were issues with this physical presence standard because it was very difficult, even though obviously when you're present in a state, they have jurisdiction over, a business or a taxpayer to say, hey, you're required to pay tax or you're required to, be our collector. But, there were some inequities with this standard because, there were concerns about, hey, this, level playing field between in-state versus out-of-state sellers. And, all that really impacts, or it could potentially impact and did, the difference between, in-staters having a huge disadvantage with, having to charge customers tax, figuring out what tax to charge, as opposed to out-of-state sellers that, if they didn't step foot in the state, they didn't have to deal with that, right? And that put them at a huge advantage. The other issue here was, taxpayers avoiding, paying tax to the jurisdiction where, they would purchase, something out of the state and then bring it into the state without having to pay. And on that end, it's really hard for a state to impose, or enforce, how these rules actually work on individual, taxpayers who, there are millions of us who buy things, and, states, it just doesn't make economic sense for them to enforce, these sales and use tax rules on individuals. So here the slide's just going to list out all the, traditional physical presence Nexus activities. So it's, you travel there, you have a location, or you have employees or independent contractors. The independent contractors, I think, for the longest time, I think people kind of assume that, hey, they're not our employees, they're just independent contractors. They really can't make us do anything, right? A state can't impose a tax collection duty on a business that, is hiring a third party contractor to do work for them. But, the Supreme Court decided in Tyler Pipe, that, hey, contractors that are creating a market for you does create Nexus. So, on this list here, there are several other activities that a lot of people don't really consider, or, they don't believe these types of things would create Nexus, but they do. And so now I fast forward to Wayfair, which now, we're in 2021. South Dakota v. Wayfair was decided back in June of 2018. And that was probably, one of the, biggest sales tax case out of the Supreme Court in many years, like in, over 20 years. And so, this case now redefines what the minimum standard is. And so it's redefined Nexus to also include this term called economic nexus. And that, concept has existed, in terms of, other state tax types, but specifically to sales and use tax, this case pretty much ruled that economic presence is enough for sales and use tax. So in South Dakota, they had a law that pretty much said that, if you have $200,000 of sales or 200 transactions in the state, that's enough to require, for the state to require a business to start, figuring out, how to charge tax and how to, collect on things that they may be selling in the state. And so when Wayfair was decided back in 2018, there were a number of states that had similar economic nexus laws or rules on the books. And so when the Supreme Court decided this, states were pretty much following lead. And fast forward to today, we're in 2021, we now have 44 out of the 45 states plus DC who have a state sales tax that now can enforce this economic nexus on businesses across the country. So, here that third slide talks about, I added Florida. Well, Florida just passed their economic nexus laws, I don't know, about a few weeks ago, maybe a month ago, and their threshold is 100,000 of sales. And, for the most part, that has been the minimum threshold that states have adopted, but it does vary depending on the states. Like bigger states such as Texas and California, New York, they have higher thresholds because the economics of the volume of business that might constitute enough nexus, right? Like, is it enough of a connection for a state to require, a business to register and be their tax collector? That threshold really is based on that constitutional, concept of, hey, we don't want to unduly burden taxpayers. So here, I list Missouri is the only state left that hasn't, put on an economic nexus rule on the books. But, we know it's coming, given what we've all gone through in the last year, over a year with COVID, states, they have huge deficits and are figuring out how to fill in that budget gap. So sales tax is definitely the way to go. As it's been a big chunk of a lot of states' budget and tax revenue. So I guess the point of this, part of this presentation is that, hey, I want y'all all know that, physical presence is still a nexus creating activity, but we now layer in this economic nexus concept, so they both coexist. So here, this slide outlines our Wayfair rules in Texas. Like I said, all these states have moved past physical presence as that minimum standard. In Texas, ours is a $500,000 threshold with no transaction requirement. And that transaction requirement generally is referring to like invoices. So, if you're selling like in states like South Dakota that have a transaction requirement, you literally may be, selling to a lot of people, very little dollar amount, and that can kick you into the requirement to start, collecting and remitting tax. Now with the effective dates, states have been kind of all over the place in terms of, when they adopted the law and when, or if they made like an administrative rule change like we did in Texas, the enforcement date can be different too. So, the comptroller, after Wayfair was decided, they made a rule change and said, hey, effective January 1, 2019, we're going to have this new threshold, and businesses selling into our state with over $500,000 are going to have to start collecting, and we're not going to enforce till October 1. And so the way they're going to figure out if they need to start collecting is, they're going to look at their sales, gross sales in Texas, and they have to look back 12 months starting, that July 1, 2018 date, because, Wayfair was decided back in June. So Texas said, well, Supreme Court says it's okay for us to enforce this economic nexus rule. So we're going to have, businesses start figuring out if they need to collect and remit in our state. Okay. And then thereafter, I believe it was, probably half a year after, the comptroller changed the rules for sales tax, they also mirrored the economic nexus standard for Texas franchise. So they've tied it together. So they've tied this $500,000 for sales tax, and they also say that same threshold applies to franchise tax. The franchise tax rules of $500,000 of Texas gross receipts would be effective at the end of 2019 and would have applied starting in the tax year of 2019 for the reports that were due on or after January 1, 2020. And so basically what this means now is that for franchise tax purposes, if you exceed that $500,000 of Texas receipts, you're now going to be required to start filing. And even if you don't owe tax, you're still going to have to, file the no tax due report. Okay, so this is here, the next few slides, I'm going to cover a quick case study in terms of how these rules work across the country. So, for the most part, a lot of businesses are selling to customers all across the country. So, you would not necessarily look at these new economic nexus rules in a vacuum. What you have to do is you have to understand, your footprint across the country, because now we have these rules everywhere except for Missouri. So this case study is pretty simple and basic. So, basically, if you have a company based out of state and you start a business, you're going to sell a good, because it's pretty straightforward when you sell a good. You're not having to figure out, hey, am I, selling a tax service, or am I, selling something that might be exempt? So this example here is pretty straightforward. It's going to be a widget, and we're going to limit the traditional Nexus activities to the state of New York. So your location, your headquarters in New York, your employees, all your property is in New York, but you have customers in a number of states. So here I've listed some sales that this company made in 2018. So I guess the question here is, so with all these new rules and laws with economic nexus, where do we have to register? So the analysis works like this. So you have to go state by state, and you have to figure out what you're doing and where you're doing it. So obviously in New York, we are physically there. We have to get a license because you have physical presence. And then in California and Missouri, because their sales didn't exceed that threshold, California has a higher threshold, and then they measure it by gross sales. And not all states measure by gross sales. Some states measure by taxable sales. So you have to actually know what rules, even if you know the dollar threshold, you really have to understand what goes into that dollar and how you measure that. And then in Missouri, it's like the only state without an economic nexus rule. So now we get to skip Missouri for the time being. Okay, in the next three here, we've all exceeded the sales threshold. And in Georgia, they use a $250,000 threshold, and they use retail sales. And so you have to understand what that means, right? So retail sales generally represent any kind of sales other than resale sales. So the point here with this case study example is that, these effective dates are all over the place. You have to understand that. And then also the enforcement date might be different. Like I said, in Texas, we have a different effective date, but we're not going to enforce it until October 1 of 2019. So what that means is that some states have the same effective and enforcement date. So if by April 1 of 2019 in California, if we exceeded that dollar threshold, you would be on the hook to start register and start collecting and remitting tax as of April 1, 2019. So, Texas was kind enough to give, taxpayers and businesses a little time to figure out if they needed to comply, while other states were like, the day you exceed, you need to come and register and start collecting. So I guess the other big point here is that, when you do register with the correct date, you should expect to pay a pretty big tax bill, especially if you're late to the game. So then, looking forward to 2019, they had a ton more sales. And if we go to the next slide, we fast forward and, we look back and we say, oh, shoot, we were late to the game in a number of states. We didn't register. We didn't know Wayfair existed. You're looking at easily, a huge tax liability. Here, this example gives you $140,000. And then on top of that, because you're late and you didn't file on time, you didn't pay on time, states, tack on that interest and penalties. And, you can usually count to just double, the tax bill with the actual liability and then the interest and penalties as well. So it is a really big deal. Okay, so here we're going to move on to another area that, is a pretty new developing area of law, meaning the marketplace facilitators. And really those laws also have come out from, Wayfair, because, the way we do business now is, internet-based. And so, we have our Amazons of the world who facilitate sales. So states across the country, I think there may be a couple left that have not yet enacted marketplace facilitator laws, but it is here. And so if we could go to the next slide. So basically this marketplace facilitator concept is pretty much extending Wayfair to, these marketplaces, our Amazons, our Etsy's, our Walmarts that are facilitating sales for third-party vendors. So basically, for businesses that haven't, maybe they haven't had enough sales to, exceed threshold, but these marketplaces collectively have. So that kind of fills in that gap where the states are trying to reach for that, that part of the market. So basically, you know, in this kind of transaction, you're going to have the seller, which is, you know, it could be any kind of seller who uses Amazon or eBay or Airbnb. And then the facilitator would, you know, be those types of marketplaces. And if we could move to the next slide. So the difficult part of this, the way this all works across the country, is that each of these marketplace laws are very unique in terms of how they define what a marketplace facilitator is, how they are imposing, you know, what's the threshold, and you know, how broad of a definition are they using in terms of who's a marketplace facilitator. And then in terms of liability, you know, it is all over the place in terms of if the right tax is not collected or the right amount is not collected, who's liable? You know, a lot of the states are saying, hey, you know, the marketplace facilitators are going to be the ones responsible for taxes that were not remitted correctly, or not the right rate wasn't collected. But not all. So basically, it's kind of unclear in terms of, there's not like a bright line rule saying, hey, the onus will be completely on the marketplace. In some states, it'll say it's only their liability if they got bad records, because, you know, in all honesty, they're the ones getting all the information from the buyer. So they know how much the sale is, they know what they're buying. So they're in the right place to do it. But again, right, not all states are defining marketplaces the same. And it's actually very broad. And then in some states, it's very narrow in terms of how this applies. And okay, so Missouri is our only state. Again, they're the Lone Ranger in terms of these new laws. So here, this slide kind of outlines what we do here in Texas in terms of the marketplace facilitator and providers. You know, Texas made the change back in October of 2019 when they changed our Wayfair rules. And so here, this is how it's defined. A marketplace is pretty much a place where you are selling a taxable item. And a marketplace seller must provide, you know, all the information necessary for the facilitator to collect and remit the correct tax. And then basically the sourcing here, the third bullet talks about it's based on where you know, the customer is. So it's a destination-based sourcing method. Here, this slide gives you definitions. Like I said, you know, some states are very broad, some are more narrow, but I mean, as you can see here, it can be any kind of means, physical, electronic, medium, you know, that connects a seller and a buyer. So we're talking about internet, a website, a catalog, anything. And then a marketplace provider is anyone who operates a marketplace. And it says that they can directly or indirectly process sales or payments for a marketplace seller. So basically, you don't really even have to take payment or process the sale to really be defined as a marketplace provider. Okay, and now here, you know, kind of what I said earlier with regards to, you know, what everyone's reaction is. Basically, it's expensive, right? Figuring out, are you a marketplace? Are you selling on a marketplace? Who's responsible for reporting? I mean, in a lot of states, you know, some states require the marketplace seller to report gross sales, including marketplace sales. Some states say, oh, no, you don't need to, you know, report your marketplace sales. Let the marketplace provider or facilitator do that. In terms of managing exemptions, who's going to manage that? Is the onus on the seller, or is it on the marketplace provider? And then also, I mean, collecting sales tax it gets really complicated, especially when, you know, you're working in the area of SaaS, software, services. All that is very difficult to even figure out. So when you're not doing it right, who's in trouble, right? Who's liable? So all those things have to be taken into consideration. And then when states start to enforce, what are they going to do? It's really uncertain at this time, but definitely this is an area to watch out for. Okay, so this is kind of our hodgepodge section. And this is an area where it's not really new. You know, I think for the most part, businesses are unaware that, you know, you have different Nexus standards, and it varies from tax type to tax types. So here in the income tax, the franchise gross receipts tax world, you know, states generally have these doing business statutes that define, you know, what constitutes nexus. What is it that requires businesses to start filing income or franchise taxes in a state? Well, you know, we have some states that have this economic nexus type of rules. These are known as factor present states. We have quite a few here I've listed that have this bright line rule that says, hey, if you have revenue of over, I think Alabama's really low, like 50, and California's really high, like 500,000 or 600,000 in the state, you have to start filing income franchise taxes in our state. So this has been around for a while, but you know, we go back to the whole physical presence. That's another thing, right? That's another activity that creates nexus, triggers nexus for income franchise tax. But the other piece of it is also sales tax. You know, these doing business statutes are pretty vague. You know, they say, you know, creating a market, doing business, it's creating that economic presence. That has been around for a while, but now with sales tax and their bright line rules, for the most part, states, you know, if they see you, you know, registered and collecting and remitting sales tax, they're going to question, well, why haven't you filed an income tax return in the state? Because essentially you are, you know, I guess doing business in the state, essentially, you know, creating a market. And so all those kind of blend together. But, you know, we call it the tax creep because truly it is. And if you're complying with, you know, kind of one tax type and not the other, I mean, you're just asking for trouble if you don't address it all. So this slide here, you know, kind of a, you know, my potpourri section here talks about sales tax automation. Sales tax automation, you know, third-party software has, you know, been around, and I think the popularity of it has grown, especially given, you know, now our new Wayfair and economic nexus rules in place, because, you know, as, you know, online and even, you know, our traditional businesses, you know, that have a storefront or, you know, or have people all across the country, you know, employees and independent contractors, I mean, they have a wide footprint now. And so things you need to think about if you're going to do it right and you want to manage your sales tax obligations, you really should consider whether or not you need to look to third party. The first thing you would want to do is, you know, decide and determine if, you know, your own ERP or your own accounting software can handle it. Meaning like maybe you sell one thing and it's very simple, and the state that you sell in have single rates, very simple. So maybe your own ERP system can handle the sales tax piece of it. If not, you definitely want to consider third-party sales tax software because for the most part, they're able to handle some of the more complicated tax decisions. They give you all the rates. These rates are updated quite frequently and different, right, from state to state in terms of how often it's updated. And then also getting the right rate in terms of jurisdiction, depending on these sourcing rules, really matter because, you know, depending on the state, it can get really complicated. So if you do come to the conclusion that you are going to seek out third-party software, you also have to ask, you know, these software companies, hey, do you integrate, right? Does your software integrate with our ERP system? Can they talk? And if they don't, you're better off moving on, looking into, you know, for other options and not wasting your time because, you know, the implementation can get very complicated, can get very costly to do any kind of customized integrations. That definitely can be challenging. You know, so the next question to consider is, you know, you should definitely ask if the software can address home rule jurisdictions. And, you know, I don't know if you all are aware, but we have a number of states that have these local municipalities that pretty much administer their own sales tax. So We have the Colorado, we have Louisiana, we have Alabama. So these states have their own municipalities, these cities and counties that, taxpayers have to register separately, get a separate license. And these tax decisions are generally different, and they vary pretty much widely, like in Colorado. All the home rule cities like Denver and Colorado Springs and Boulder, all those cities impose tax differently and have different rates. And so if the software isn't able to address these home rule jurisdictions, you just leave yourself exposed to a lot of tax not collected or not collected right. And then here, the last question here is, does the third-party software vendor provide training and support services? And I mean, we've seen this over and over that typically most of these software providers are selling software and they don't necessarily provide you any kind of service in terms of making sure things are set up correctly, making sure how to implement it correctly so that you're not exposed to any kind of risk. This probably is one of the biggest considerations, even though you think, oh, I just need something to calculate the right tax, or I need something to get me the right reporting. But truly the support here is really important. So again, so that support, meaning these software companies really don't provide that. So you really need to consider whether you have resources internally or you have service providers to help you do that, to help ensure that what was calculated, what was collected was correct. And so, basically it is not a set it and forget it, because, these laws change, and you need to make sure that even if as you change as a business, your decisions are updated. Like when you integrate with your accounting system, you're setting it, it's very specific to each of your line items. So everything that you sell, every service that you provide, it has to be mapped and lined up correctly for the software to work. So basically, you just need to make sure you have the right resources to manage that if you do decide to outsource it, that someone's watching the farm. And then, the third point here relates to exemption certificates. Not all exemption certificate management systems are the same, and you really need to consider, depending on how you do business, if you have a need for a separate system, or are you are you selling to any exempt entities? All those things need to be considered. And then, many times, we have clients that actually, they go to different software providers for the exemption certificate management side of it, because, one software company could provide it all, but it may not meet your needs in terms of their volume or, the complexity of what you're selling, because maybe all of your customers have a broad, wholesale, or maybe they're an exempt entity. So you need to make sure the system meets the needs that you have. And then here with the last bullet with pricing. So it's generally transaction based. So the more transactions you have, generally the higher the cost of the software will be. So you also have to kind of consider and also, I guess, shop around to see if the software provider is, their pricing level is something that is in line with the way you do business. Okay, so this next slide here, we're going to dive into sourcing. And so the sourcing concept is truly, is actually very important, because it helps you understand what to tax, where to tax, and who to give that tax to. So basically, states use two generic methods to figure out where the tax goes. One is origin and the other is destination. So in origin-based sourcing, under the origin-based sourcing rules, there are different things that you have to consider if you need to follow these origin-based rules. So the first thing you have to consider is, hey, do you have Nexus in a state that has origin-based Nexus rules? And then the other is, well, do we have Nexus because we are just selling into the state, or do we actually have somebody there physically doing things, taking orders, making sales in the state? And then with destination, that is pretty much, we source the sale, we charge tax based on where the product is delivered. And I mean, most of the states follow destination-based rules. There are a handful of states that use origin-based, and then we have some with mixed. And Texas is one of those. So this is a really fun and not fun. This is very complicated in Texas because we do have a mixed sourcing regime here, because the differences between intrastate sales versus interstate sales differ widely, because our sales, businesses that are just outside of Texas selling into the state, we've used destination based. So that is the general rule. But with regards to intrastate sales, meaning you're a business in Texas selling in locations in the state, the rules get very complicated, and it really depends on how you transact business, because it will be based on where the order was received, and it will be based on where it was received, where it was fulfilled. Texas's rules are really complicated at the local level, because we have that state rate of 6.25%, but then from the local end, there's a max of 2%. And we have a sales tax piece of it, but then there's also another layer of use tax that these local jurisdictions they can impose. So there's kind of a collection order here in Texas. We have city, county, special purpose districts, and then transit authorities. And so the hierarchy there is, the top jurisdictions get their money first, and anything left over goes to the others. And like I said earlier, it really depends on how you transact business to figure out how you source that sale. Like I said, here in Texas, it's very complicated, and we also had some recent changes in terms of sourcing for online sales. The comptroller recently, in the last year, over a year ago, they proposed some changes in terms of how local sourcing rules would work. And I guess the impetus of this change was to really discourage these economic development arrangements. These municipalities were entering with businesses, because they wanted businesses to relocate to their, to their city, to their county, so that they obviously could get more sales tax. With the origin-based rules, that means, like, say an order was received at a business location in the jurisdiction, it would typically be sourced there, depending on the other parts of the transaction. But because of the way that worked, a lot of these cities and counties were entering agreements with these businesses to say, hey, if you relocate here, we'll give you a cut of tax. So the comptroller was trying to squash that, and he actually delayed implementation of these new sourcing rules. And so now, if we go to the next slide, we have quite a few bills being considered, or at least proposed. And so, and the different types of bills and the different sourcing methods are all over the place. I mean, there's one bill, House Bill 4072, is using a destination-based sourcing for all sales, including in-state, online sales. The next bullet, House Bill 4261 and 3538, are pushing to have, the sourcing rules to revert back to what they were prior to the amendment. And then the last set there is pushing for destinations based sourcing rules for online and marketplace sales. We have a couple more here. Basically, very similar to destination, where the sales source to the location where it's stored or where the customer receives possession. And that's where it gets complicated, because it's trying to address situations where, the order wasn't placed at the same location. So it's kind of given some definite sourcing to like a destination where the customer is. The last bullet here with sales source to a seller's place of business, this kind of preserves, the agreement between the business and the city or county, so that they can still source sales to that jurisdiction, so that the business is still able to receive that benefit for moving to that jurisdiction. And here, this bill was actually remote seller sourcing. So this is a single local use tax rate that, when Wayfair was passed, the comptroller wanted to make it easier for, remote sellers. So basically, it's an election that online remote sellers can make. And we've had clients who have, because, figuring out all the different local sourcing rules can get really complicated. So basically, taxpayers can make this election if they qualify. And then if they no longer want to use the single rate, they will have to apply for it to be revoked. So this is another bucket here. I think I mentioned earlier, we have these home rule jurisdictions. So Alabama, Alaska, Arizona, Colorado, Louisiana are the states with these home rule municipalities. And so with Wayfair, imposing this economic nexus standard, on businesses, can negatively impact interstate commerce. So these states have basically pushed for simplification. They have pushed to make it easier for online and remote businesses to collect and figure out, how they can comply, the registration process. All these states are kind of working to create that simplification. And, notably in Colorado, which is probably one of the worst. I mean, they have over 70 home rule jurisdictions. And, they, over the last, I want to say 2 or 3 years, they've put together, there's a legislative task force that has really worked hard to create a system at the state level to centralize registration, to simplify the collection, and then also, pretty much help taxpayers who do business in Colorado, because I mean, at this time, a lot of these home rule jurisdictions do have like a Wayfair economic nexus ordinance on the books, but they really can't enforce it because of this constitutional limitation, right? Like they can impose a tax that unduly burdens interstate commerce. So with that, I think we are moving to make it easier and better for taxpayers to comply. But I mean, aside from that, it still gets very complicated in terms of figuring out the nexus, right? Do you have nexus? Because the rules are all different. Figuring out like, how do I measure it, right? What's the period do I have to look at to figure out if I even owe it? And then also the registration, figuring out when do I register? Because the risk that you run into if you just register prospectively, when you do the registration, you are signing under penalty of perjury that what you're putting on the application is true and correct. And if you put a wrong date on there, there are, ramifications, as well as you're opening yourself up to a lot of risk and liability. So that's, I think, the bulk of our presentation today. I think the next few slides are some resources, because, from, the differences between state tax versus like federal taxes is that, you have one code you deal with, and you have the IRS that they publish guidance and rulings and bulletins. But at the state level, I mean, you're dealing with so many, you have your, 50 states plus DC, and then you're dealing with the home rule jurisdictions. And a lot of times the states are not as transparent. So you kind of have to go to a lot of different resources to figure out, all these crazy rules, all the different things that you have to know and understand to comply. So I've listed a bunch of resources for you to have.
Is TaxOps based in Colorado? Is that right?
Yes. Yep.
Yeah. Plenty to keep you busy there, huh?
Oh, absolutely.
Yeah.
Absolutely. Yeah. No.
Yeah. Okay. So,
yeah. So, I mean, definitely the more being aware, hey, this is kind of some of the things that you need to consider. And your facts do matter. I guess that is the biggest thing I would emphasize, like really understanding your business and understanding your business in a way that you probably wouldn't think of, because it's important to know, how you market, right? How do you reach your customer base? Like, what are you doing, right? And so, you might get a Nexus questionnaire from a state, and you may answer it in such a way that the state says, oh, you should have been filing, or you should have been registered a long time ago. So it's really important to know yourself, so that you're answering these questionnaires correctly, and you really know your truth. And then here it's just our website, and we also have the Saltivations, a separate website from our TaxOps website, but I mean, it's got a ton of information. There's tools, information. I mean, the more you know. So
perfect.
And yeah.
So we had a question earlier. Is Economic Nexus only applied to retail sales, not wholesale sales?
It depends on the state. There are a lot of states that say gross sales. So gross sales are going to be wholesale and retail. Some states are going to be taxable sales only. So I guess that is another big thing. A lot of businesses that mainly wholesale, they may think, oh, we have nothing to worry about. But no, in states that do count your wholesale sales, they're going to expect you to register. They're going to expect you to have the right docs, meaning you have the right exemption certificates, and all that good stuff, so that they make sure you're doing things right.
Okay. Well, thank you so much, Tram. We greatly appreciate it. The materials page has the slides posted there. So Tram's contact information is there in those slides. Your certificate and survey have been posted on that page as well. That's tx.cpa/Fort Worth/Nexus. It's posted there in the chat for you guys. I think that's it for the questions. I am sorry about the technical difficulties that we had there for a minute, Tram. You powered through. No problem. Like the professional you are. So greatly appreciate it.
Thanks,
all right,
ladies.
You guys. So once again, very thankful to have a fellow member kind of catching us up on what's going on in today, particularly with sales tax. So thank y'all for joining us. Tram, thank you. Everyone have a great day. Appreciate it.